Welcome to our module on management accounting. When you hear the term accounting in everyday life, we probably don't mean management accounting, we probably mean financial accounting. Well, they are throwing two new words at you, management accounting and financial accounting. What's the difference? Financial accounting deals with the company's books and taxes. So if you're tracking how much money the company made last year or what the company's worth, those are financial accounting tasks. Management accounting is more internal. So management accounting is really most basically the application of basic mathematics to solving business problems. So how can we spot when somebody's talking about management accounting? Well, we can use the buzzword bingo. Here are buzzwords that you will hear at work, and they all indicate that a management accounting activity is going on. The term business case is most often used to describe an analysis, almost always with numbers, to determine whether or not the company should do something. So you might hear someone say, what's the business case for developing that new application? What's the business case for moving to a new office? Business cases often include break-even analysis. A break-even analysis is a mathematical calculation that we perform to determine how long or how many is or are required to get back an investment. So an example of a break-even analysis might be if you're going to start up a shoe shine shack. Let's say it costs $100 to buy the polish and the brushes, everything you need to get started for your shoe shine shack. $100 investment. Well, a question that follows very closely is, how many pairs of shoes do I need to shine before I break even? That's a break-even analysis. When I calculate how many pairs of shoes I have to shine in order to earn back my investment of $100 that I had to spend to get my shoe shine business, that's a break-even analysis. Contribution margin is almost always used in a break-even analysis, especially in manufacturing or service business like a shoe shine shack. So the contribution margin in our shoe shine example would be for each additional pair of shoes I shine, how much profit do I make? So that would be the revenue I get, say I charge $1 per shoe shine, minus any costs that I need to have, or costs that are associated with shining those shoes, like the amount of polish I use, the number of rags I use. Transfer pricing has some financial accounting implications, but it's inherently an internal decision. So what's transfer pricing? Imagine that we have a company like HP Canada. HP Canada is a wholly owned subsidiary of HP. What that means is HP Canada is a company all on its own. It files taxes with the Canadian government, but it's completely owned by HP. So HP Canada sells a printer. Sell it for $1,000. Question is, where did HP Canada get it? Well, they got it from HP. How much did HP Canada pay HP for that printer? Well, coming up with that number is determining transfer pricing. And the reason it has financial accounting implications is sometimes companies will set that transfer pricing so that they make all of their profit in one jurisdiction or another. Case in point, one of the years I worked at HP, we had a great year. We had revenue of $1 billion. HP Canada sold $1 billion worth of stuff. And it was a good year. Everybody got their bonuses. Everybody was happy. Do you know how much HP Canada made that year? Sales of $1 billion, profit $1,000. Doesn't sound like a very good year. Well, why was the profit so low? The profit was low because HP, our parent company, decided that they'd rather show the profit at HP than at HP Canada. So they set the transfer pricing such that HP Canada made almost nothing. If you hear somebody talk about making a decision to buy something or lease it, you get bingo on management accounting. Overhead allocation often plays into business cases, and overhead allocation simply is of all the costs that apply to the whole company. For example, rent of the office space. How much of that rent is allocated or said to be spent for any given department? And overhead allocation comes into play when we talk about profit centers. And a profit center is a way of carving up the profit of a company down to the individual department. So you can imagine Hewlett Packard again, just to beat that horse. HP sold printers and they sold servers. Internally, HP tracked how much money they made on the printer business versus how much money they made on the server business. Yet the printer guys and the server guys ate in the same cafeteria. So the rent for the cafeteria, how much of that goes to the printer business and how much goes to the server business? A profit center is, in my previous example, the printer business or the server business. They're both part of HP, and ultimately the profit gets reported for the whole company, but internally HP wants to know how profitable each of those pieces is. So they define each of them as a profit center. And the terms that go along with that are often P&L. So if a manager is assigned P&L, that is to say they're responsible in some way for profit and loss for a part of the company. And that's usually a pretty senior position. We need to have some solid definitions in management accounting. Some of these things are terms that have common meaning in English, but a little bit different meaning when we apply them to management accounting. A good example is cost and price. In everyday life, cost and price are the same thing. Right? You might say, what was the price of that Coke from the vending machine? Or what did that Coke from the vending machine cost you? In everyday conversation, they mean the same thing. But in business, they have specific meanings that are applied very consistently. Cost is what a business pays for something. And price is what a business charges for something. So if now I'm the operator of the vending machine, if I pay my supplier 25 cents per can of Coca-Cola, my cost is 25 cents per can. And if I sell those Cokes for $1 each, the price is $1. Fixed costs and variable costs go hand in hand. Any given cost, that is to say, any money the business spends, is either going to be a fixed cost or a variable cost. Fixed costs are the costs that don't change with the amount of stuff I do. In my shoe shine business, a fixed cost would be the rent that I have to pay for my shoe shine shack. Whether I shine 10 shoes or 100 shoes, the rent is the same. Variable cost in my shoe shine example would be, what's the cost of shoe polish per pair of shoes I shine? Shine more shoes, have more shoe polish cost. Margin and markup are both a way of tracking how much money we make on reselling something. Margin is how much we make as a percentage of the total selling cost. And markup is how much we increase the price based on the cost we paid. There's some detailed backup on margin and markup that I encourage you to look at. It's just below this in the table of contents. So let's look at a simple business case. Now this business case is trivial, but the process that we're going to go through to evaluate this business case is pretty much the process that we would go through for a big $1 million business case. So the problem or the question is we're considering outsourcing our help desk. Right? We currently have a help desk technician, and we provide them with a desk and a computer and a telephone, and they answer the phone and help people with their computer problems. We estimate that the total cost for that is $10,000 a month. We're considering outsourcing that to a different company, and they're going to charge us $2,000 a month plus $20 every time we call them. So the question we're interested in now is, should we outsource our help desk? Well, as is so often the case, that depends. And it depends on how many calls a month do we expect to handle. So let's consider 3 scenarios. If we have 10 calls a month, 100 calls a month, or 1,000 calls a month. Now, as software developers, you probably should be saying, bing, 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 that sounds like a job for a spreadsheet. Because it is a job for a spreadsheet. Here's what our spreadsheet might look like. We'll have a column for calls per month, so we can type in whatever number of calls we want in the month, and then we'll see ultimately whether we saved with our outsourcing. To provide a little more detail, we have the cost in-house, and the cost in-house doesn't change with the number of calls. The outsourced cost does. It's $2,000 plus $20 for each call. So we can see from this simple spreadsheet-like table that at 10 calls we save money, at 100 calls we save money, at 1,000 calls we don't save money anymore. So focusing just on the spreadsheet first, question would be, which columns should be formulas? I think the cost for outsourcing and the savings should be formulas, because they're the ones that vary, and they vary with the number of calls per month, and we're investigating the number of calls per month. So when we build a spreadsheet, we tend to put the number that drives the other numbers in the first column, and then use formulas as we go across. We talked about break-even analysis only a few slides ago. Now it's time to do some. Key question is, how many calls a month do we need to have our outsourcing deal save us money? Well, we go back to our spreadsheet, we see that at 100 calls a month, we save money. At 1,000 calls a month, we're not saving money anymore. So somewhere between 100 and 1,000 is the point where we don't make money anymore, or don't save money anymore with this deal. So the correct way to do this is algebra. But you gotta do some math, and most business people really don't like to do math. So the most common way to do this in the wild is to just estimate, to try a bunch of values and see where we go from saving to losing on the deal. Now in the old days with pencil and paper, that could be pretty laborious, even with a calculator. But spreadsheets make it pretty easy. So let's look at our practice exercises. First of all, I'd like you to use algebra to find the solution. Then I'd like you to build a spreadsheet kind of like the one that I showed you, or the sample I showed you a few slides ago, to find the answer. Then I'd like you to build a spreadsheet that allows you to see how different parameters in the outsourcing contract, that'd be a different cost per month or a different cost per call, would impact the break-even point. Now, solutions to these exercises are posted on Canvas. I'm old, I should say Canvas. But please try these on your own first, because understanding these and working on them on your own will help prepare you for the graded exercise. In the graded exercise, you're going to build a spreadsheet to evaluate the business case for building a password reset application. All that information is on Canvas, and everything you need to know is there. So you're now not experts, but you have a pretty good grounding in management accounting if you followed everything we've done. Thanks. Talk to you later.